Hi everyone, my name is Abhinav and I'll be taking the faculty course for you. I hope that you have seen the orientation class, you have attended my orientation session. Or in case you have not attended, you would have seen the LMS or the video for the same. In case you have not seen the video or the LMS, I suggest you to go through the same because therein I have covered a lot of ground for the preparation of the CPA, specifically for the BEC. Right? Though obviously we are going to cover the much more in detail in the course of the session and in the course of the classes, but it's always better that we are all on the same page, and understanding is always is pretty much all the same from across the board. So that's why I suggest just have a look whenever you just get a chance. Just have a look at that LMS in the video. Yes. So I hope everyone can see my screen. Yeah. So we'll start with the BEC2, right? I'm starting with this topic because it is more finance, and this is what I understand that most of you would have read somewhere in your college, in your CA, in your MBA, or any other qualification. I think it's pretty much something we have done it already, and so yeah, that's going to be much easier for you to understand, right? So I'll start with, in case you now suppose you start. You think that I'm done with my job and I want to start something on my own. I'm not getting the enough kick in my work profile. I need to start some business, right? So when you look to start any business, right, what are the things that you look for? For example, you decide like, okay, let's start a furniture business. Like, what are the things that you actually look when you're starting to start a business? So for example, I'll take an example, like what are the things that you, for example, you're looking to start a business of a furniture, right? Rightly said, people said the capital, you need a budget, how you need to arrange the capital, right? But I think the basic thing would be, what would you do with the capital? What would you do with the budgeting, right? So I think the very basic on the day one, what we like, okay, I will start the furniture business, but what do I need for that? I need a, say, machinery for that, right? I need a machinery for that. So how to make it, you need machinery for the same, right? Where will you keep this machinery? You need a factory for the same, right? So for example, you said that I'm going to sell on in my own, so probably you need a showroom for the same, right? You need some cash so that you can have a petty cash for your daily needs. So you need some cash for that also, right? So these are the broad things you'll need. You need a land also so that you can start you can keep your machinery, your showroom, everything. So you need a land for that also. So these are the basic things you look for that, right? When you're looking for that. And okay, we have understood you need this, but how would you actually arrange that? Like, what will you do? What you'll do is basically, see, for example, you have done your savings, right? Over a period of time you've been working, you would have your own savings, right? So you will fetch those savings and use it for this, right? Or maybe in case you have any investments, you will go ahead and liquidate those investments and go for that. In case you have some cash line, use that. If you're done exhausting entirely funds, you probably go to your parents, your friends, family, and then ask for more money, right? So friends and family, you will go and ask for it, right? After you have exhausted all the people, right, whatever who are not known to you, what will you do? You go to the bank and ask for the bank loan, right? So this is the basically how would you do it. So these are the things what we call is generally called the sources of finance or the sources of funding. And when you use these sources to this, it's called the application of funds. So it's very easy peasy, nothing complicated in that. This is something we have been reading since 12th, right? So basically the key point, the trigger is the application of fund. How do you want to, like, I want to buy this, I want to buy this, and then you look for that, how would I arrange the funding for that? How would I arrange the sourcing for that same? So this is the same thing, right? So you decide that I want machinery, I want factory, I want showroom, I want land, and then you say, okay, how can I arrange the funds, right? These are the means I can arrange the funds. If we put these things in a statement, we call that statement as a bank balance sheet. It's a very, very basic, and I hope everyone understand that, right? So if I say machinery, plant and machinery, sorry, plant and machinery is the same thing. And then you have building. Okay, so we were discussing about the sources of funds and the application of funds. We said obviously we need the factory, we need the plant and machinery, we need the furniture, we need everything to prepare that furniture, and then how we arrange that fund is called the sources of funds, right? If we plot everything in the statement, which is we call as balance sheet, right? Right? So how will it come? So it's going to be plant and machinery. It's going to be furnitures and fixtures, whatever you are keeping in your offices, showroom. Then you have a building, some cash, and how you're actually funding it? It's from your equity share capital. In case you are raising some preference share capital, in case you are raising some debt, the bank loan. So I'll keep on using the debt and the loan in our same terms, so don't get confused with it. It's just the same thing, right? So we'll keep on using. So that's what it is. It is something which is the sources of funds, and this is something which is the application of funds. Okay, great. So we have started the business, right? And now we'll start the operations of the business, right? So what will happen? You ask a person, and that person, you need some material for that. So you go to a supplier and say, can you just supply me some material so that guys can start some business? That person gives you a material. So that person gives you a material on 1st January, and the material reaches to you, and you need 30 days to prepare that. So almost 31 days. So by the time your material is ready on 31st January, your finished goods is ready. So your material is ready by the time. Then you sell that material to another person, your buyer, and you give 30 days credit, right? You said 28 days credit. Say, go and give me money after 28 days, right? So the money, the person will give you on 20th February, right? Person will give you money on 20th February, right? But the supplier will say, I need the money right now, right? So on the 1st January, he say, I need the money right now. I don't care about when will you get the money, but I need the money right now. So what will you do as a businessman? What will you go? What will you do? You go to a bank. You'll go to a bank, right? Sorry about my drawing. Just a moment. Yeah. Sorry, what has happened? Yeah. You'll go to a bank and request the bank, can you please pay this person, because this guy is banging my door and I need the money to be paid to this guy. So can you please pay? Bank will get, sure, we'll pay you, but we'll charge some interest to you, right? You said, don't worry about the money, I'll give you the interest, but first please pay this person. So the bank pays the person on the days, and then when the money comes on 28th February, right, you pay it to the bank. So bank will charge interest for 2 months, right, which is entire January and entire February, right? This entire arrangement is the operations of the business, and this what you call as working capital financing, right? Or you can say working capital funding. It's a very simplistic way of doing it, but that's what it is, right? It's a very, very simple thing. I'm sure everyone is aware of it, right? We'll discuss the working capital, how to arrange, what are the various ratios, what are things we should see, is the working capital is the ultimate thing we should look for. Everything we'll do in the coming modules, but it's just to create that outlook, right? Okay. So now how the balance sheet will look for you. Now we have added the working capital thing also. So you will have a fixed assets, what we have done earlier, and you will have a current assets. What will you have current? You will have stock, you will have debtors, account receivable, you will have cash, right? So you will have current assets. Here what will you have? Your equity share capital, you will have preference share capital, you will have debt, debt will have two categories, the secured debts, and then you have unsecured debt, and then you'll have a working capital financing also, working capital loans basically, which could be a part of the unsecured also, right? So this category of asset is called the short-term assets. This is long-term. This entire thing, say it is going to be long-term, and this is something which is going to be short-term, right? So when you say the long-term, and the short-term in the asset side, right? What do you mean by that? So that means that you can liquidate and get that money in case of a short-term. You will get that money in a period of 1 year maximum, right? So you get the money in 30 days also, 60 days also, but maximum in 1 year you'll get this money back. What is long-term? You will earn money out of it in the longer run, not immediately, but over a period of time. So that is the meaning of application in case of a long-term and short-term. What does that mean in case of a long-term loans and the liability? Right? Liability, what does that mean? You don't have to pay these liability right now. You have to pay them over a period of time. So for example, 1 year, 2 years, 3 years, 4 years, but not immediately. Short-term, what do you mean? You mean that you don't have to pay it, you have to pay them right now, right now, or maybe in 30 days, maybe 60 days, 90 days, right? But maximum within a span of 1 year, right? So ideally, the more idealistic scenario would be the long-term should fund, I'm sorry, we don't have space. Ideally, the long-term should fund long-term, right? It's more like a marriage, right? So you have fund long-term should fund long-term, and the short-term should fund short-term. Okay. What do you might fund? The way we have discussed, how would you fund that application? So the long-term should fund the long-term. It's more like the way I said, it's going to be marriage, and the short-term should fund the short-term. It's more like a Tinder date, right? So it is just like that only. Ideally, this is a scenario. In case, what you can also still do in case you're not finding the short-term loans funding because you're not following that covenants, you're not following the conditions, you're not getting that loan. You can still fund your current assets, right? Your short-term still can fund through the long-term. You can still fund that, right? So what is the arrangement? I'll just quickly jot it down here. Long-term and short-term. So this is okay. This is okay. This is also okay, right? When you're looking to fund this, right? You're looking to fund your short-term asset with a long-term. Slightly okay if you are able to pay within the time. But in case you are looking, if you fund this short-term loans with the long-term loans, this is a problem. Ideally, you should not do that. Why you should not do that? Because in case you have to pay the short-term liability. What is short-term liability? That you are paying that person within a span of 30 to 90 days. And you don't have money. What will you do? You will not go and sell your plant and machinery, right? So this is what called the liquidity problem. A similar situation was happening in case of IRNFS. They could not pay their commercial papers, and they have to then eventually face so much problem because of that. More or less a similar problem was there also. So you should not go for this arrangement. Obviously, when the business is growing, it's a rapidly expansion, then it looks very fancy and the glossy that you can actually fund the long-term assets also with the short-term financing because the money is churning really well. But just if there is a downfall, it would be very difficult for you to fund the long-term asset with the short-term. So ideally, you should not do that. I hope it is clear till here. I'll take up the queries at the end of the session, right? And we'll make the arrangement for the WhatsApp group also, so that we can discuss the query as and when it happens. If we start taking the queries in between, it will be very difficult to conduct the entire session. So just please bear with that. I'm just giving you a minute, so in case you want to make anything, note anything, just note it down. Okay. Okay. So when we are talking about the balance sheet, right? Now let's see only the sources side, the liability side, right? Just see that only. So here equity share capital, preference share capital, secured loans, and then you have unsecured loans. Throughout our understanding, what we have started, whenever we have heard, right, we always think about when there is a high risk, right? Whenever there is a high risk, that person is always expecting the high return, right? This is something like हम बचपन से पढ़ रहे हैं ऐसा कि जितनी ज़्यादा risk होगी and there will be high return for the same, right? And the person will expect the highest return. Here, the person in this, the person who is taking the least risk would be the secured loan, right? By this person, right? Because this is something which is already secured with the fixed assets, right? So this person's risk is the least, right? So this person is sleeping well, right? Because his risk is already covered by the fixed assets, right? So if I sort it out on the basis of the liquidity, on the basis of the risk, I would say secured creditors would be on the number one. So least, when I'm saying about the least risk, that person would be the first. Second would be the unsecured loans, because once the company gets liquidated, first the secured creditors will get their money. Secondly, the unsecured creditors will get their money. Third, obviously, in case before the equity shareholders comes the preference shareholder, and lastly, the poor equity shareholders will get the money. I think it's a very easy concept, and we all are aware of that, and I don't think we need to dwell in that further. In case you have a question, please drop that on the message on the WhatsApp. In case you want still clarification on that, we can discuss that also later. So yeah, that's on the basis of the risk. So what we have done, we have said the risk is the higher. The person will be expecting the highest return here. So in that case, going by that logic, the highest risk is taken by the equity shareholder. So if I talk about the return or maybe the cost, his cost expectation of the return would be the number one. Then the second would be the preference share capital. Third would be the unsecured loans, and the fourth would be the unsecured loans, right? Because that person would be taking the highest risk and would be taking the highest return, expecting the highest return. The person who is taking the least risk would be expecting the least amount of risk. It's a very easy concept. I don't think that there is anything complicated in that. We'll keep on dwelling this concept going forward. So that's just, I'm trying to just tell you the pace. So I'm just giving you a second just in case you want to note it down. Yeah. Okay, great. Okay. Before we go ahead, I just want to discuss a small format of the income statement. And then we can take it forward and take in the material. One of the income statement, the format that we'll use in the P&L format going forward. Okay, this format, the format which I use for the balance sheet, and the format which I'm telling you about the P&L, this is not as per the US GAAP, this is not as per the IFRS, this is not as per the Schedule 6, Schedule 3. It's the more about the finance understanding, right? Because don't think the business topic as a very much accounts driven or the regulation or the more of a format driven, because this is not, right? This is your understanding of the finance will play into it, not the accounting knowledge, right? So understand from that angle only. So we'll be focusing more from the finance perspective rather than the accounting perspective, right? So let's just make this format also in case, because we'll be using this format a lot going forward. So sales or revenue, what we call. And from that, if you reduce the cost of goods sold, you will get your EBITDA. And from the EBITDA, if you reduce the depreciation and amortizations, you will get EBIT. And from EBIT, if you reduce the interest expense, which is net, you get PBT. And from that, if you reduce the tax, you get PAT. And if you divide this PAT with number of equity shares, you get your EPS, and from this will come only to an income statement, and from this, if you reduce the dividend, this would be the amount which will go to balance sheet in reserve and surplus, right, which would be retained in business, and this will go to balance sheet. I just want you to just note it down, because this is something we'll be referring again and again, and would be helpful if you can actually, we'll keep on discussing this on the basis of this. I'll give just 2 minutes so that you can actually write it down. Just ping me 1 or 2 guys when you're done writing this, so that I can take it forward. Okay, great. Shall I go ahead? Don't take screenshot, else it'll take time for you to, you'll be eating the time for the revision, and you'll be taking time to make the notes. Shall we? Okay, 2 done. Let's go ahead with that. Okay, now we can come on our book, B2, BEC2, and just a moment. This, yeah, the first thing. Before we start, a small pointer also. So we have categorized the debt. We have categorized the debt into category, which is secured and unsecured, right? So debt or loan, whatever you want to say, right? Unsecured and secured. And we have sent the return, the person who would be expecting the higher return would obviously the unsecured. Why? Because that person is taking more risk. This is the risk of this person is already secured by the collateral or maybe the mortgage that person is having, right? So we can categorize in the category of this, right? So now we have understood the debt. We have understood there are different categories. We have understood equity. We have understood debt. We have to understand the preferences. Let's understand the various categories, like various instrument in each category. Let's understand that, right? Okay, now the question comes, is this exhaustive list? No, this is just not exhaustive. In case you look for the funding instruments, there would be approximately like thousands of the instrument that you can have it, but here we are limiting for the couple of instrument only, and beyond that, in case I think you need to add, I'll cover those things also, but I don't think you need to go anything beyond this also, right? So let's just start. Okay, so let's start with the first. Let me just adjust the screen. Just a moment. So entities capital structure. So we are doing the capital structure components, right? So entities capital structure is a mix of debt, and it's a mix of debt and long-term obligations, right? So long-term and short-term. Equity is going to be common and the preferred. Common is the normal equity that we understand, and then it's a preferred is a preferential capital that we understand. Debt is obviously we have done is going to be long-term and short-term. It's just to finance your operations and growth of the business, right? And these are the various debt financing instruments, right? Entities use the various forms of the short-term and the long-term debt in their capital structures, right? You use the debt short-term also, you use the long-term also. The common forms of the short-term debts include the short-term notes payable. So let's just mark this. Sorry. So short-term is going to be short-term notes payable, commercial paper, line of credit arrangements. Long-term will include long-term notes payable, debentures, bonds, and financial leases. I understand all of you understand notes payable, commercial paper, which is something which is line of arrangement. What is line of arrangement? Line of arrangement is yeah. So this is line of arrangement. So what is line of arrangement? When the facility of funding, the working capital funding is given to you, right? And with the option that you can raise that funding as and when you need it, right? For example, the facility is given to you, facility of say $100 million is given to you, right? This is the line of credit, like line of credit is given to you, but the option you can use it as and when you need. For example, 100 million is given, and out of the 100 million you have used only 20 million, right? You use the 20 million. Going forward, as the year is progressing, out of this you again use another 10, and it's become 30. And then you use going more, you use 70 of it. Good part about the line of credit is you are supposed to pay only the amount that you have utilized, not the entire 100 million. So herein, interest would be charged not on 100 million, it would be charged only on $20 million, right? Similarly, it would be charged on $30 million, here would be charged on $70 million. In case you get the collection later on and you want to reduce the facility, you can definitely reduce that, and you pay the money and you have been reduced down to another $20 million, then again you will pay paid only on the $20 million, not on the $100 million. So this is a way of the working capital financing, and this arrangement is called the line of credit. This particular facility is called the revolving line of credit. We'll do line of credit in much detail when we progress in the other modules. In case you want to note, please note. Yeah. So yeah, coming to this, we're done. The short term includes the short term notes payable, commercial paper, line of credit arrangements. Long term includes long term notes payable, debentures, bonds, and the financial leases. Okay. Now let's understand the commercial papers. Commercial papers is the working capital financing. Okay, what is working capital financing? Something we have done. You are using it to fund the current assets. You're using it to repay the current liabilities, right? Generally, it ranges to 30 days, right? In case it is, in case you want to issue it for more than 270 days, you need the registration with SEC. I'll really make it on a general note so that I can cover more of it. Okay. So what is commercial paper? It's a short-term instrument. It's a short-term funding. It is a working capital financing. What is short-term? That is, it is not for the long term. So it is not for the long term. It is not for more than 1 year. It is a working capital financing. Generally, it ranges to 30 days. If it is, you can issue it. If it is max till 270 days, or if it is more than 270 days. If it is more than 270 days, it needs the registration with SEC. Here, no registration is required. Max meaning is going to be more or less than 270 days. Generally, company prefer going in this. Why? Because here you have to bear a lot of compliance. Here the compliance is higher because obviously the SEC compliance, and here the cost is also higher because of the compliance cost and the filing cost and everything. So generally the company prefer this round of this. Yeah. I'm just noting here so that you can, in case you want to note it down, you can do that. It is generally issued by large corporations and investors are, so it is something which is issued to the investors, and it is generally the large corporations. Investors are generally the HNIs, high net worth individuals, and institutional investors. But going the thrust, now a lot of retail investors have started participating in this also, because they find it a very lucrative the investment model for them. I'll just move to the next page and I'll come back to this so that you can note. It is generally issued at discount. Issued at discount and redeemed at face value. So for example, you need approximately $10 million. So you issue at the entire cash value, and then you redeem it, for example, approximately 11 million. So this is the interest that you have to pay. This is the difference that you pay to interest. Okay, it's a part of money market. It's a money market instrument. We'll discuss that. What is money market? What is capital market? What is financial market? Primary market? Secondary market? We'll do that. Yeah, it's a money market instrument. So yeah, these are the features of the commercial paper. I'll just go back on the top so that in case you want to note, please do that. And noting for this also. Once you're done writing both, would be helpful if you can let me know. I'll take up all the queries. I'll take up all the queries. Don't worry about the queries. I'll take up all the queries. Let me just structure and finish it, and then we can take up the queries. and we'll decide the modalities also, how we can structure the queries. In case you have done writing, just send me a, just let me know. Great. So let's go to material and just see what is there, and we can do that. Okay. Yes. So commercial paper is an unsecured short-term debt of instrument, right? So we have done, it is unsecured. It is short-term, issued by a corporation. Commercial paper matures in 270 days or less. So this is what we did. It is maximum 270 days. The threshold above which the commercial paper must be registered with SEC. So that means if it is more than 270 days, you have to do with SEC registration, right? Then the proceeds from the commercial paper must be used for financing the current assets or inventory or to meet the short-term obligation. So it's basically the working capital financing. So this is one of the examples, right? For example, you have make a note of that. In case you think this is something which is already captured there, I suggest you to cut it down because you've already captured the entire essence in that. So there's just no point duplicating that, right? In case you feel the essence is already captured, just cut it from there. Otherwise, you'll keep on duplicating the things. Yeah. Okay. Now let's see what is the second instrument. Second is debentures. A debenture represents an unsecured obligation. It is also an unsecured obligation of the issuing company. In the event of the default, right? In case of a default, what is happening? The holder of the debenture has the status of the general creditors. It's a general creditor. So that means you become the unsecured creditors and you will get the money after the secured creditors are paid, right? However, the risk associated with the debentures may be mitigated. You can mitigate the risk. How would you do that? By mitigating by a negative pledge clause, right? That stops a company from pledging the assets to the additional debt. What is negative pledge clause? For example, I think we have space, we can do that here. For example, we have a fixed assets of say $500 million, right? And you have a secured debtors of say approximately $300 million, right? So now you are issuing say debentures here, and you are issuing the debenture of say 100. So here you create the negative pledge. Then now there would not be a more secured debtors. Why? Because in case more secured debtors comes here, for example, let's assume there are more secured debtors comes here. Say for example 200 million. Then this guy and this guy will consume the entire fixed assets, right? And there will be nothing left for the debentures holder, right? Will be nothing. That's why they create the negative pledge clause, saying that they will stops the company from pledging the assets to the additional debt. I would say additional secured debt. So that they can intact there. So there would not be any secured debtors. So with this, after they pay the secured debtors, after that 200 is left, and that will be go to the debentures holder or maybe the other holders who are at the same level. So with this, they are actually mitigating their risk. In case you're bringing more secured debenture holders or the debt, it would be difficult for them to get that money. Okay. Next is subordinated debt. Subordinated debt is a bond issue, right? That is unsecured, and it is something which ranks behind the senior creditor, right? So for example, senior creditors, secured creditors, it is again the unsecured, and then in case whatever is left for the unsecured debtors, you will get that thing, right? In the event of a liquidation, right? Issuer liquidation, subordinated debentures command the higher interest. You'll get the higher interest here than the debentures here. So here, if you see the rating wise, obviously there's going to be secured debt, then there would be debentures who are doing the negative pledge clause, and then there would be a subordinated debt. Obviously there could be more instrument and according, that's not exhaustive, but on the basis of this understanding I'm just telling you this. So this would be the rating on the basis of that. Yeah. So the way the logic we have done, they will command the higher interest rate then the debentures to allow for the additional risk. The same thing we have done, high risk, and they'll ask for the high return. Yeah. Okay. Next is the income bonds. What is income bonds? Income bonds represent the securities that pay the interest only upon the achievement of target income, on the achievements of target income levels, right? For example, you said that you will get the interest only if you have achieved say PAT of so you have achieved an EBIT of $100 million. Only then you'll get the interest. So this is again, you're setting your target, only then you'll get that money, that kind of money. Income bonds represents a risky bond. It's a very risky bond that typically only used in case of a reorganization. For example, you're doing a merger or acquisition, you're buying any company, you're selling any company, any form of reorganization is happening, then you issue this kind of income bonds, right? So why is that also? Why that? Because generally what happens when you're doing the reorganization, synergy will take time to build in. It will take a couple of years to set that kind of synergy and earning that profits. But when you have such a loan on your head, it would be very difficult to cater that. That's why they come with this clause that once we achieve that kind of number, say $100 million in that case, only then we'll distribute the interest. Otherwise, no. Because in that case, it would be very difficult to have a fixed obligation on your head, right? Okay. Next in line we have junk bonds. Oh, just a second. Okay. Then we have the junk bonds. Junk bonds are also called high yield bonds. So junk bonds, already it says it's complete rubbish. It's a complete rubbish bonds, and this is called the high yield. Same logic, high risk. You're taking a lot of risk and you're getting a very high return in that case, right? So this is that kind of bonds, like junk bond. So for example, let's take an example of say Yes Bank, right? Yes Bank in such a bad shape, right? But now if the Yes Bank issues the bond, who will take that? Who will subscribe that bonds? I guess very few people. I think no one will subscribe rather. The people will buy only if they have a strong conviction, then it will be a complete turnaround, and with that I'll earn more profits. So someone will invest only in that because they think that it would be a turnaround story, and then I can earn the profit. So it's a very high risk thing, but you're doing it because you are expecting a very high growth in that. Only then you'll invest in that. So this is that junk bond which is issued by the company who's completely defunct, which is in a really terrible shape. This is issued by them. Generally, it is something which is issued in case of a LBO, which is called leverage buyout. It is generally issued by them only. Leverage buyout is generally done by the private equities only. So this is where it is done. Right? Let's just read that so that we understand more. Junk bonds are categorized by the high default risk and the high return. The same logic we done. Junk bonds are classified as a non-investment grade, right? This is the non-investment grade. It is not an advisable investment, right? By the major credit rating agency, for generally the CRISIL, ICRA, S&P, Fitch. Given they're more likely default on the principal, so the chances are very high that you're going to default on the principal and the interest. So they're more likely default on the principal and on the interest, right? By the issuer. Junk bonds are frequently used. These are frequently used to raise the capital for acquisitions and the leverage buyout, which is called the LBOs also. So this is something which is used for the acquisition part, and this is something which is used for the leverage buyouts also. Okay. What is leverage buyout? Leverage buyout is when you're acquiring any company by raising a lot of debt, right? Instead of paying them from your own pocket, you're raising the debt. For example, this company is acquiring another target company, and instead of paying the cash to this person out of their pocket, they're not paying, they're raising the debt, right? And they're raising this debt to pay this company. This is called the LBO. It is generally used by the PE firms. Generally, the percentage is approximately debt is almost 90%, and equity is almost 10%. There are many deals which has happened there. I think Blackstone did with Hilton Hotels, I guess, somewhere in 2008 to somewhere around 2007 or something. So that's how you structure the deals. You don't pay out of your pockets. You raise the debt, and then you repay that the target company. Yeah. So we've done the high yield bonds. Okay. Let's do the illustration of the junk bonds. Rust Belt industry is looking to close its manufacturing plant in the small town Oxidation, Ohio, right? So they're looking to close their manufacturing plant in that case. The company is only major employer in the Oxidation, right? This is the only major employer in the, right? To preserve their way of life, employees have decided to buy the company from its current owner. So the employees are looking to buy the company from its current owners. The group of the employees completed a leverage buyout. So they have completed a leverage buyout of the owners by issuing a non-investment grade, the junk bonds, or the way I told you also, it is called the high yield bonds also. Because these employees don't have money to pay out of their pockets, so they have issued the junk bonds and use that money to pay the owners of the company. Yeah. So next in line is mortgage bonds, right? So what is mortgage bonds? I'll just share file. Yeah. Okay. So what happens? Any person who's looking for a loan goes to a bank and take a loan from that bank, and the bank asks for the collateral. That person will say, okay, I have a house or I have the office, I can give you as a collateral to you, and if I don't pay that, you can use this and you can forfeit this, right? So when so many people, like many people, take the loans like that, and they keep on submitting their houses because of that. Sorry about my bad drawing. I'll try it again. And when you add the entire loan, the chunk of the entire loan, so there are many, and you just club them all, you just pool the entire loan of it, and you issue as a bond. When you issue entire loan as bonds, and how would you issue that? You get it verified, you get it rated by rating agencies. This bond is rating agencies, and on the basis of the rating, the investors will give you the money. This entire arrangement is called the mortgage bonds, right? What is the security for the investors? The security is going to be the collateral. This is going to be the collateral. Whatever the collateral which was given to the banks is the collateral, is the security for the investors. Here the advantage is that in case the homeowner default, right, the investor do not need to go and forfeit on their own. There is a custodian here. There is a custodian here who forfeits this and give that money, repay that money to the investors. So this is something the investor does not need to do. Yeah. This is something which being used in subprime crisis a big time. A big time is something which is used there. The instrument which was used for the CDO, which is called the collateralized debt obligation, and so CDO is a much bigger version of the mortgage bonds. So I would say if mortgage bonds, so I would say CDO is more like a mortgage bonds on the steroids, right? It is that strong, and that is being done in a much greater chunk, and we all know how the recession of 2008 has happened because of that only. So this is the more or less modus operandi which was followed that during the subprime crisis. Just have a quick just have a look at that, and just have it noted, and then we can go forward. Once you're done writing, would be helpful if you can just let me know. Just ping once you're done writing. Okay. I hope everyone has written. Okay, now let's read. A mortgage loan is a loan that is secured, we're done, that is something which is secured by the residential or the commercial real property. Mortgage are usually pooled together, we have done that, we have pooled the entire chunk, and is issued as a mortgage bonds. With the bondholders protected from the default, how would you protecting that? They are protecting by default in the lien or the pooled real property stage, right? A distinguishing feature of the mortgage bonds is that the trustee act as a custodian of the bondholders to foreclose on the mortgage assets in the event of the default. So here the trustee act on behalf of the bondholders in the event of default. Yeah. Okay. Okay, I hope it is clear. Lastly is leasing. We all understand what is leasing. So you decide that the property, I'm not sure whether I should buy the property. So what do? You basically go and rent it. So what is leasing? You're going for rent and you're not purchasing. So this is leasing, right? Okay. Okay. Lease is something which we will cover extensively in the FAR. We have almost 2 modules on just lease. Herein we'll understand only from the instrument perspective, right? We'll not be covering from the LSR part because this is the investment part of it. We're looking at for the lessee angle only, right? And we're doing very brief because we are considering only the instrument part of it, right? How are you actually funding that lease, right? So we know what is lease. So when the lessor gives the property to the lessee, the person who is a user, this arrangement is called lease. Lease could be of the operating lease, it could be finance lease. In IFRS, I understand that there is no operating lease, there is only financial lease, right? Okay. So when do you know it is an operating lease or it is a financial lease, right? Okay. If lease is more than 12 months, so this is the test you'll do. If the lease is more than 12 months, if it is yes, if it is no, what do you mean by no? That it is less than, not less than rather, it is less than equal to 12 months, right? 12 months. In that case, this would be an operating lease, right? If it is more than 12 months, there would be another test where we'll do it. If 1 by 5 condition is satisfied. If it is yes, or could be no. If it is satisfied, in that case, it is going to be a financial lease. If it is not, they're going to be an operating lease. Okay, what is 1 by 5 condition? We'll discuss that. Don't worry on that. Right? I just suggest you just note it down so that we can go ahead. Okay, so what is 1 by 5? There are 5 conditions. If you are satisfying, which is called OWNES, if you are satisfying either one of the conditions, in that case, that would be a financial lease, right? In case you're not satisfying, that means you're not even satisfying one of the condition, it would be categorized as the operating lease, right? Let's go to the material and see. Okay. A lease represents a contractual agreement in which the owner of the asset, the lessor, allows the another party, which is called lessee, to use. Lessee is owner is lessor. The person who is using is a lessee, the property in exchange for the periodic lease payments, right? So a lessee will classify a lease on its books as the operating lease or the financial lease, right? We'll discuss this para later. And yeah, assuming that the certain parameters are met, right? A lessee can make the accounting treatment election to not recognize the asset and liabilities with a 12 months period or less. So it's your choice. In case if it is less than 12 months, in case you think you don't want to recognize, you will not recognize that. So the condition we were discussing about the owns is this. So this is O, this is W, this is N, this is E, and this is S. So let's understand these conditions one by one. The first is the ownership transfer at the end of the lease. So for example, you have entered into a lease agreement, and the ownership is getting transferred at the end of the lease. In that case, that lease will be treated as a financial lease. Second, you have done the written purchase agreement that I will for sure I'll buy that. I'm very sure that I'm going to exercise the option of buying that at the end of the lease. If that is the case, then it is also called the financial lease. Third, when your net present value of all the lease payments plus the residual value, the guaranteed residual value is equal to and more than substantially exceeds the underlying fair value. That means your present value of lease rentals plus GRV is more than the fair value. So what does that mean is actually the fair value, whatever is that, if you bring the lease rentals to the current value now and you compare it with the fair value, you're already using it, you're already paying much more than that, the real value. So when you're paying much more than that, so that means you have exhausted the entire asset completely. So in that case, that would be considered as the financial lease, right? Next is economic life is almost equal to the lease term life. So for example, generally the laptops are meant for the 3 to 5 years, right? And you're taking the lease on the laptops on the 3 to 5 years. So that means you're using it for the economic life of that. So in that category also, it will be considered as a financial lease. Okay. Lastly, you have designed the asset like that. For example, you asked someone to create a laptop for you which is specially designed by you and no one can actually use that. So in that case, you have specifically asked for that particular asset and you will use it after you will continue using it. In that case, this is also considered the financial lease, right? So let's understand one by one. So ownership transfer at the end of the lease, which is called O. W is written purchase option that the lessee is reasonably certain to exercise. So you're certain, you're very sure that it is something which is exercised. Third is net present value. This is something we have done. Net present value of the lease rentals and the GRV is more than the fair value. Next is economic value. Economic life of the underlying asset is primarily encompasses the term. It is the term of the lease. It is more or less equal to the term of the lease. Next is there is a specialized asset. Okay. Why are we doing this kind of categorization? Like why are we looking for this category and the criteria? So what are we looking with this criteria? We are testing if you're using the asset full time, like the asset life is 10 years and you have completely used the asset, and after that the asset is completely defunct and no one can use that, so that means you are more or less the owner of that asset, right? Vis-a-vis, if the asset is still usable by some other person, right, then it is still the operating, which is more like a rental. Here the nature is more like an owner of the asset. That's why it's very important to categorize that, whether it is a financial lease or the operating lease, and then you accordingly, because the treatment is different in both the cases, right? So that's why it's very important to classify that thing. So I'll go back to the sheet again, and we can do that. So that's why we have done. In case the lease is for more than 12 months, right? It is going to be operating lease. It is, if it is less than 12 months, it is operating lease. If it is one by condition you satisfy, it is a financial lease. If it is not, it is an operating lease. And we have done owns here. The treatment of both the lease is going to be similar, is more or less is going to be similar in case of a lessee. However, there is a slight difference here. We'll do that. Okay. Now let's come to this. For the operating lease, the lease expense, for the operating lease, the lease expense represent the interest expense and the amortization of the ROU asset. So yes, the lessee will classify the lease on its books as either the operating lease or the finance lease, both. Both the type of the lease will result in the lessee recording a right to use of assets and the lease liability on the balance sheet, right? So when you're making your balance sheet, you will show it an asset type, you will show the this, and herein you will show the as a liability. Both would be the equal amount, right? This is the same treatment whether it is an operating lease or it is a financial lease. The difference comes in case of a P&L, right, for both. Herein you are showing both the categories. Under the lease expense. So this is something you will amortize over a period of life of the, this is something you will amortize, and this is something you will pay. So automatically it will keep on knocking off with each other, right? And that's how you show in case of an operating lease. How would you show in case of a financial lease? You show it separately in case of a financial lease. That's it. That's the only difference. There would be a lot of differences in case of there would be a lot of criteria for the lesson, but this is the part of the FAR and we will not discussing that. But for the finance side of it, this is the only difference. Yeah. So yes, that covers our various instrument for the debt. There is a small example for the lease. Let's just see that, and then we'll go quickly for the revision. Leasing. Philips Manufacturing Company is working on its strategic plan for the upcoming year, right? The company is looking to expand due to the increased product demand, right? The company must expand its manufacturing by either constructing. So you have the choice, either you construct or you lease, right? So it is the choice, right? Whether either is you buy or you put it on lease, an existing manufacturing facility for the next 5 years. You're looking at the horizon for more than 5 years, right? The management carefully weighs the both options. What are the both options? Either you buy or you lease it out. You're evaluating both the options and recommends leasing facility using the lease based on the following. And they have evaluated both the option and then they will eventually go ahead with the leasing. Why? Because of these reasons. First, it's a tax advantage offered by the leasing given the Philips existing marginal tax rates, because your tax rate is like that you will get the advantage over there. So marginal tax rate, you're getting the tax advantage here. That's why you've taken that decision. Generally the tax advantage is something which is already there in case you buy also, because therein you get the advantage of the depreciation also. Second advantage that I'm mentioning is you will have a low, since your company have a low financial leverage, since the debt equity level of the company is very low, in that case you can still go ahead and go for the lease liability. The company has a low financial leverage, which means the lease liability recorded on the balance sheet will not have as harmful as impact as it would the company had the high financial leverage. So debt equity is lesser, the financial leverage is lesser, so you can go ahead and record the lease liability accordingly, right? This would be also defeated in case you borrow the money and buy the property. In that case, will have the same impact, because your debt equity is lower, your financial leverage is lower, and you borrow the money and then buy it, it will give the same impact for that only. I think the third point is the major point where the leasing is very helpful, which is the local real estate prices have been highly volatile. See, prices is very highly volatile. So it makes more sense to not invest in a property when the prices are so volatile, and you can easily go and lease it out rather than buying and investing in a property for which the prices are very volatile. This is the very good law. This is the good reason, rather, I would say, for the leasing. Leasing provides an additional flexibility, right? It provides an additional flexibility to you, align the management to reassess the lease versus the buying decisions and the level of the product demands in the 5 years. You can gauge after 5 years you think it is not relevant, but when you bought the property, it is your property, and what if the prices have gone down for that? You cannot get away with that. But if it is the lease, you can still get away with that. So that's the advantage of the lease, right? I'll stop here and I'll probably start a quick round of revision what we have done till now, so that it does not become a little overwhelming for you. So that, yeah. Okay. So we'll start with a short revision. I suggest you to open the notes, whatever the commercial notes, which I have commercial paper notes we have done. I suggest you start revising with me so that it becomes much easier for you to revise that. So we've done commercial paper. It's a working capital financing. Generally, it is the 30 days. It could be more than 270 days, but if it is more than 270 days, it has to be registered with SEC. Generally, the companies prefer the commercial papers which is less than 270 days because of the less of cost compliance, because of the lesser compliance, because of the lesser cost. It's a working capital financing. It's a short-term financing arrangement. It's an unsecured arrangement. It's an unsecured debt. Generally, it is issued by the large corporation. Earlier, the investors are used to be HNIs, large corporation, but now the retail investors are also coming into it. It is a money market operation. It is a money market instrument which is there. Second, we have done the debentures. Debentures is which is unsecured. Again, it is an unsecured, but in debentures you can have a negative pledge. What is negative pledge? Negative pledge is it helps you in restricting the securities, the secured debtors, and you can limit your interest in that. So this is the debentures. Third, we have done subordinated debt. Subordinated debt is an unsecured debt again, but this will fall after the debentures, right? So in case the liquidation is happening, first the secured creditors will get, then the debentures will get, then the subordinated debt will get, right? Then we have done the income bonds. What is income bonds? Income bond is something that you will get only after you satisfy a target income, right? This is generally issued in case of a reorganization. So for example, you have achieved the target of $100 million, only then you can get that interest amount, right? So generally used for the reorganization. And then we have done the junk bond. Junk bond is generally which is issued by the corporation which are not in so great shape. This is also called the high yield bonds. It is a non-investment grade category. This is generally used in case of a LBO or in case of a restructuring. This is something generally used by them, right? And then we have done the mortgage bonds. What is mortgage bonds? Mortgage bonds is something where the bonds are issued against the mortgage of the property, right? And those loans are pooled together, and against those loans, the mortgage bonds are issued, and the ratings are given on the basis of the mortgage bonds. And here the custodian is allocated. So in case of a default, the investor does not need to go to the loan holder. The custodian will act that it will liquidate the property and give it the money to the investor, right? And then finally we have done the lease. There are two categories of the lease: operating lease and the financial lease. So in case if you satisfy, if the lease is for more than 12 months or the less 12 months, if it is for less than 12 months, it is going to be operating lease. If it is for more than 12 months, it is going to be, we have to see another 5 conditions. So if it is 1/5 or there's no condition you're satisfying. So conditions, if not satisfying any condition, it will be operating lease. If you're satisfying either 1/5, it is going to be financial lease. What are those conditions? This is going to be owns. The first is ownership transfer at the end of the this lease term. Second is you have a written option that you can exercise that option, and it is very certain that you can exercise that option. And is the net present value of the lease payments plus the GRV is almost equal to the fair value of the asset. Is the economic life of the asset is almost equal to the lease term, and S is something that you specially design asset for you, right? I know revision is a little faster I have done, but that's the whole idea, so that we're just scrolling it again and again, and there's something which is staying in our mind. Okay, let me just so we have done the various instruments for the debt. Now let's understand the equity, and that's how we'll cover the entire the instrument for this. The way I said earlier also, it is not an exhaustive list. It is just the illustrative list, just to get you the sense what kind of the various instrument could be, right? So let's start with the equity financing. Equity financing involves the issuance of the equity securities that represent the different forms of the ownership of the company, right? It basically shows the different forms of the ownership. So basically these are the owners of the company. A distinguished feature of the equity security is the right of the shareholders to the firm's asset in case of a bankruptcy, right, are less than that of both the secured and the unsecured bondholders. This is something we have already done. In case of liquidation or bankruptcy, less than both of the secured and the unsecured bondholders we have done. This is, you have the last right on the assets of the company. Here there are two categories. We have the secured, we have the unsecured, we have the preferred, and then we have the equity. First is the preferred, which we all in India we call the preference share capital, right? Preferred stock is a hybrid, it's a hybrid equity security that has the features similar to both the debt and the equity. It has a component of both the debt and equity. Preferred shares require fixed dividend payments to their holders. So basically you have the option of getting the fixed dividend payments to their holders, which is similar to the coupon payments, right? Which is similar to the coupon payment, like the debt holders. You have the options. They are like the equity because the timing of the dividend payment is at the discretion of the board of directors. So they are more like a debt because it is a fixed, and they're more like a equity because it is at the discretion of the board, right? Which is similar to the coupon bonds. So the way we have said, the way it is mentioned earlier, it is a hybrid because you have both the features of the debt and the equity. Debt because you get the fixed amount of the coupon. Equity because you will not get as per your wish, and it is not mandatory. It is, you will get only when the board decides you to do that, right? So it's a hybrid instrument. So it's not mandatory, right? And the dividend payments are not tax deductible. So dividend payments are not tax deductible. We'll get to that in detail when we do the cost of various instruments. Preferred shares may have the following features and the uses. So these are the various uses and the features of the preferred shares, right? First, it's a cumulative dividend. So it is a cumulative dividend, right? A cumulative provision on the preferred stock may require that the unpaid dividends in arrears. For example, you have the fixed dividend of 10%, but now the board is saying we don't have enough resources and will not pay you right now. So it will pile up to the next year, and when the next year when the dividend is getting distributed, you will get the earlier arrears dividend as well, right? So cumulative provision on the preferred stock may require that the unpaid dividend in arrears on the preferred stock from the prior period be paid prior to the distribution of the common stock. So for example, when you're issuing a dividend, in that case preferred dividend will get their arrears, then they'll get for the current year, and then the equity shareholders will get their current year dividend, right? So this is going to, so they'll get the arrears for the preferred, and then you get the current for the preferred, and then the equity shareholders will get for the current year, right? So I'm just reading it because I understand that everyone would be aware of these are the very basic things. In case you still have no clarity on that, you can just ping your queries and we can discuss them, right? Next is we have what is a participating feature. A preferred shares may participate in the declared dividends along with the common shareholders to the extent that the undistributed dividends exist after satisfying both the preferred dividends requirements and the common stakeholders requirement at the preferred dividend rate. For example, once you have paid the dividend, right? You have paid the dividend, still the company is deciding we can still pay more dividend. In that case also preferred dividend can participate. It's not like you will not say that they have already got the dividend and now you will not get any dividend. In case the company is also evaluating to give more dividend to the equity shareholders, you can still come and say, okay, I also need that dividend, right? So it's just like that. It won't be like that once you're paid and you're out of it. No, it is not. Voting rights. In rare circumstances, right? In very rare circumstances, the preferred students are given the voting rights. So they are giving the voting rights, but that voting right is generally limited only to their own rights, right? For example, regarding their issues of shares, regarding their dividends, generally is limited to that only. Usually these conditions are associated with the dividends. Generally, it is something usually which is going to be dividend in errors for the significant periods, which is just that only, right? Okay. Now the common stock, we call in India, we call it equity shareholders or equity share capital also. So yeah. So common stock. What is common stock? Common stock represents the basic equity ownership. It represents the basic equity ownership of a corporation. Common stocks include the voting rights. This is the crucial points. They have the voting rights, right? This is the most important thing, with the optional dividend payments, right, by the issuer, right? So in case the board of directors decide that you will get the dividend, only then you will get the dividend. It's not the mandatory like the preference shares, right? Most common shares issued are stated with par value. It is stated at the par value. When the common stock is issued at a given market price, for example, you are issuing at a given market price. See, for example, par value is $10, right? And the market price is somewhere around, say, $50, right? In that case, what would you do? You segregate that. $40 will come in the, sorry. $10 will come in the face value, and this $40 will come in the additional paid in capital, right? So when the common stock is issued at a given market value, which is $40 and $50 in our case, the proceeds received by the issuer are separated between the common stock account, that is the par value, right, which is $10 in our case, right, and multiplied by number of equity shares, and the add-in capital account, right, which is $40. A negative feature of the, what is the negative feature of the common equity share is that the common shareholders have the lowest claim. They have the lowest claim of the firm's asset in case of a liquidation. In case if the company is looking for a liquidation, they'll have the least amount of claim in the assets. But we have said they are taking the maximum risk, and when they are looking for the maximum risk, they would be expecting the maximum return as well, right? So that is why the equity shareholders have the maximum return also. So it's a good summary. It's a very good summary. So I would say it summarizes everything, the difference between the debt and equity. Let's go with one by one. The following table summarizes. So it's a great summary, I would say. Some of the general characteristics of the debt and the equity. Flexibility. Debt, you don't have any flexibility. It is very much static. In equity, you have the flexibility. Tax deductibility. In debt, you have, because the interest comes over the PAT. So yes, you get the tax deduction here, but here you do not get because it comes after the PAT. We'll discuss that also. EPT dilution, it does not happen because it is not impacting your equity shareholders, so there is no EPS dilution in that. But in case you are issuing more equity, obviously number of share will increase, and that will result in the EPS dilution. Increased financial risk. Obviously yes, because your debt equity, your leverage will increase, and that will obviously increase your financial risk also. But equity, obviously it is something which is, in case you're issuing the equity, you're not increasing the financial risk. In fact, you're diluting your financial risk. Security issuing cost is generally low because you're not going in the capital market, but in equity it is generally high because you're going to the capital market. Capital market could be two, like secondary and the primary market. There the compliance cost is very high. So generally it's the issuance cost, and not only the issuance cost, but the compliance cost is also very high. Investor return, debt is generally fixed, and it is something which is variable here also. There's one more point I would say. The investor return is fixed. I would say return here is slightly lower, and here is high. It could be high. If it is going high, generally return is high in that case. So yeah. So let's just summarize everything. Then really we can break for 5-10 minutes also. What we have done the various instruments for the debt and equity. Debt, what we have done the commercial paper, we have done the debentures, we have done the subordinated debt, we have done the junk bonds, we have done the mortgage bonds. In that we have done the lease also. Various things we have already discussed that. After that, we have done the stocks. Stock could be of the two categories. The first is the preferred stock, and the second is the equity stock. Preferred, it could be cumulative dividend. When you are getting the arrears, it will keep on piling up, and when the company is issuing the dividend, the arrears will get first, then the current dividend, the preference will get, and then the equity shareholders will get their dividend. Equity shareholders, they will, there is no surety of the dividend. You will get only when the board is declaring the dividend to you. They have the highest cost, and they have the maximum amount of the risk to them, right? And in case of a liquidation, you will get the money at the last, right? So this is pretty much the summary we have done. Obviously we have done much in detail, the commercial paper and everything. We'll keep on revising that. And in case you have any question, I suggest you to keep shooting that question, or I suggest in case you have a question on the WhatsApp group, what we can do is, it would be very helpful if you can shoot the queries, very specific queries, what queries you have, so that I can address those queries in the part of on the session only. So I'll dedicate 15 to 20 minutes only for the queries at the end of the session. So would be very helpful if you can just ask your queries on the WhatsApp, and very specific queries, so that I can address those in the next class, right? So, there's so many WhatsApp messages which keeps on going. I suggest if you can just on the top of the query, you can write just ask AR, so that I can filter out those queries on my WhatsApp when I'm just doing it, and then I can take it up during the class. You can shoot your queries on the group, and I can address that. Otherwise, okay, in case you have any specific point or something, you want anything, you can WhatsApp me on this number also. In case you have anything you want to discuss or anything, you can ping me and we can discuss that also. Though I'm very late on the WhatsApp, but we can discuss that thing. In case you have any suggestion, in case you want the speed of the class to go a little faster or slower, we can do that. In case you want whatever the changes that you want in your suggestion, just let me know. And then we can actually take it forward from that. The whole point of the class is that you should get the value. In case you need, the whole idea is that you clear this exam, right? So in case you want any changes, we can do that. In case you have facing any technical problem, we can address that also. So address them, but don't worry about that. Slowly, within a couple of classes, we'll speed up the pace of the class, and I hope with that we can address a lot of issues for you also. So let's break for 15 minutes and then we can resume. Yeah, thank you. Hi everyone. So let's start the session. Right. So till now we have done the various forms of the debt and the various form of the equity, which is preference and dividend, or preference and equity shareholders. Now we have done that. We have done in case there is a high risk and they would be expecting a higher return, right? So when we are saying the return, right, it is a return for the person who is making the investment, but it is a parallelly a cost for the person who is incurring it. Meaning, for example, you are working in a company, right, and the company is paying you a salary. So this salary is an income for you, but is an expense for the company, right? Similarly, the investor who is, or maybe the investor who is making the investment in the company, for that investor, it's a return, and for the company, it's a cost, right? So both terms are the same thing, but it's just a different way of looking at it. So if you apply the same logic, so if it is something which is very risky and you're expecting a high return for that, so that means the cost of that instrument is going to be high again, correct? Based on the same logic. So now let's understand the various categories, like let's understand the cost for equity shareholders, for preference share capital, and for debt holders. Let's individually understand the cost for each every one. Okay. Now, how would you calculate a return for anything? For example, you make an investment of $100, say on 1st January, and on 31st December, you get the money $110. And if I ask you, what is your return? Or how would you calculate? You will see difference of this. So 110 minus 100 divided by 100 is going to be 10%. So basically, the income that you are earning divided by the principal is something will give you the return, correct? Same logic will apply for every category, right? It's a very crude method. Obviously, it's a very crude method. But if you see, the more or less the same approach is going to be applied here also. For example, when I talk about the debentures, for the debt, what would it be? It is going to be interest divided by the debt outstanding. It's going to be the interest, which is called cost of debt, which is the KD. Preference is going to be the dividend which they are getting divided by the face value or the proceeds, whatever the money you have received from preference holders. It is going to be called as KP. Cost of equity is again the same thing. Whatever the dividend you are getting plus the value of the market value of that share is going to be the cost of equity, which is denoted by cost of equity. It's a very crude method, but that's the basic premise. That's a basic premise of handling that. Now let's understand each category one by one. So starting with the cost of debt. I know it's a very, very basic topic and we are covering a very basic ground today. I understand this is something which you might be thinking we have done exhaustively in CA and other courses. But we are just covering the basic ground here so that we can get going after that. Okay. In case of debt has a very, in comparison with the equity and the preference, debt has a very peculiar nature. It has something called the tax advantage, right? Which is not in case of equity and the preference shares. What is that? Let's do it with an example, right? For example, there are two scenarios, right? And suppose, and there is EBIT in both the cases is 100, and then from that we'll reduce the interest. Suppose there is no interest in case of a second scenario, and in case of first there is an interest of 30, so it would be 70. Here it is going to be 100, right, which is called PBT. And from that, if I reduce the tax, say 30%, it is going to be 21 here, and it's going to be 30 here. So it's going to be 70. It's going to be 9, 49. That is going to be this. Okay. Here, if you see, there is an increased tax outflow. In second scenario where there is no interest, there is an increased tax outflow of $9. You're paying $9 more because there is no interest expense here. That's why you have to pay a more cost here, right? You have to bear a more cost here. You have to pay more tax. So this is the net advantage of interest. This is the advantage of a loan. This advantage is called the tax shield. tax shield, tax advantage. So herein, what is the cost for you? The cost is going to be $30, right? Whatever the interest expense you're paying, and this is the cost, and then you're getting the benefit of, so this is the cost and this is the benefit that you're getting, in the sense you're saving that money. So what is the net cost for you? Net cost for you is going to be 21. I hope it is clear. So this is the net cost for you. So that is why when we calculate the cost of debt, we always reduce 1 minus tax to get that tax shield impact, and that we divide by the outstanding debt outstanding to calculate the KD percentage. I hope it is clear. In case you want to just jot it down, you can do that. Very basic. We must have done in our college or something. This is something we would have done. Okay, so I'll do it one more time. So there are two scenarios. First, EBIT in both the scenarios is 100. Interest, so for example, in this case, this is 100% equity funded, and this is funded by debt also. So there is interest here, right? And after reducing the interest, you'll get PBT of 70 here and 100 here, right? And then you pay the tax, the same format that we have noted earlier also. And the tax is going to be 21 here and 30 here. Here you're paying more tax, right? Here you're paying less tax. Here you're paying less tax because you have the interest cost. That interest is giving you that advantage. So here you are saving lesser, you are saving the tax more, right? That is why we reduce this part, right? So in case you go for this option, right, you're paying the lesser taxes, and that is why we capture it here as a benefit. Here it is the cost for you, this is the cost for you, we captured it here, and this is the benefit that you're getting because in the terms of saving, in the terms of tax savings. That's why we added as a benefit to it, right? And then you'll say the net impact. What is the net impact, right? It happens with anything, right? For example, you go and buy anything, right? And say for example, you buy anything for $100, right? And in return, you get something as an advantage, as a freebie of $10. Then you will say that my net advantage is 90, my net cost is $90. You will not say my net cost is $100. You will say my net cost is 90 because 100 minus 10. Same logic here also, you're getting the tax advantage, I'm reducing the tax advantage, and I'm doing the net cost. And that is what we are plugging in the formula also. The same formula we have done earlier, and that's why we are plugging this tax shield here also. I hope it is clear. Okay, great. Okay, so that's about it. I hope you have noted that. Okay, there are a couple of points which I want you to write for the new cost of debt. So point number one, because this could be slightly tricky when you're doing the MCQ. So there are a couple of points I want you to write. In case cost percentage is given to you in the questions. So in MCQs, there would be a lot of variation given to you. You would be given the interest amount also, would be given the percentage also. So how would you calculate that? So in case in the question, the percentage of cost is not given. Percentage of cost is given or not given, right? So that means I'm talking about the cost of debt. If it is given, use that. In case it is not given, then you have to calculate. How will you calculate? It would be interest, 1 minus tax, the same formula we have done, and the debt outstanding rather than net debt. What is net debt? So for example, when you're raising any debt, you have to pay some charges on that. So that will be debt minus the bank charges, in case you have to pay bank charges, you reduce that. In case you have to pay any flotation cost, you'll reduce that, or any other charges, related charges, you'll reduce that, because and then you'll get the net debt, right? Because you will calculate on what is the net amount, what is the net cash flow I have received, right? You will not calculate the impact on the total value. So you will say, what is the money which I have received? So that is why you calculate on the net cash flow. So this is note number 1. Okay. Note number 2. In case percentage is given, right? Cost of debt is given, but it is not given whether it is pre-tax or it is post-tax, right? Not given. Whether it is pre-tax or not given. And tax percentage is, or tax rate is also not given. In that case, assume it is post-tax rate only, right? So when I say pre-tax, post-tax, it is the same thing. Post-tax is basically after considering the impact of considering the impact of the tax sheet. So when you multiply with this, it is the post-tax. If you're not multiplying that, it is the pre-tax. So in case both the rates are given to you and it is not mentioned whether it is a post-tax or pre-tax, and the rate percentage is also not given to you, then you assume it is a post-tax and accordingly give your answer in the MCQ or the simulation, whatever it is. Can you just guys ping me when it is, once you're done writing it, right? Would be helpful. Let me know once you're done writing so that I can move to the next sheet. Sorry. Okay. So, which tax part you want to understand? Tarun, could you just explain me more? As in the pre-tax, post-tax? Okay. So when you're adjusting, right? For example, let just people write it, then I can move it to the next sheet. Just ping me once you guys done writing. Piyush, we can think about, we can discuss with the team and share you the slide, but I suggest you, it would be very helpful that you keep on jotting down wherever it is relevant. Otherwise, what will happen that it will be all over the place. One book is separate and the notes are separate. Then it will not make the head and tail of it. And you will be cutting your revision window if you are making notes later. But still, we'll work on that and try to share that with you. Okay, if you guys done, then I can move. Shall I move? Seems to be a bigger chart. Shall I go ahead? Move? Okay, great. So the question was, what is the pre-tax and post-tax? So for example, when I say the coupon is basically the interest rate which is mentioned. The bank is charging is 10%, but 10% is something which is the gross amount. But in that you're getting the tax advantage also. You're getting the tax savings also, right? Which is your marginal tax rate. Say for example 30%. So now you're getting the advantage of 30% on that also. So that is why we reduce the 30% of 10 also, which is 3% here in the form of that, and that becomes the post-tax rate. It is post-tax and it is pre-tax. When you're reducing the advantage of tax, so I'll go back to the earlier slide here, right? Here, obviously, like how much percentage you're paying? You're obviously paying 10% here, right? But here you're actually getting the advantage. In case you don't have debt here, you have to pay 30. But now because you have a debt, you're paying lesser amount. You're paying $9 less because of that. So this is the advantage for you, right? Because of this cost, you're getting this advantage. So we need to factor in that advantage. When we factor in that advantage, this is what is called the tax shield. So this is the formula is capturing that thing. This is the coupon rate, which is the $30, right? And when I minus this, when I add this benefit, which is $9, the net amount becomes $21. And this is something I've expressed in the percentage terms. That's it. I think it is clear. Okay, you're saying assume that the tax rate is not given, then assume this point I think you're asking about. So what happened in case the tax you are giving just the percentage, in case you are giving say 5%, and here you don't have the tax rate given to you, assume it is just the post tax. It is not mentioned whether it is pre-tax or the post tax. Assume it is this 5% is post tax only. Okay. Okay, so I'll go to, so we have done 2 notes, and now the note number 3. When the percentage is given, right? When you are given, you have effective rate of interest, and you have the coupon rate also, or the interest percentage is given to you. If both are given, herein you should use effective interest rate. You will use effective interest rate, not the coupon interest rate. I'll discuss what is effective interest rate, right? Okay. What is effective interest rate? For example, you have been given the coupon of 10%, and you have taken a loan of say $1,000, right? And there are some floating charges that you have to bear, say $50. So the net amount you will receive is going to be $950, right? Which is 1000 minus 50. So this is the coupon rate in case this is given to you. And how would you calculate the effective rate? Effective rate would be 10%, which is 100 divided by 950, which is roughly around, I guess it should be somewhere around 11%. So you will use this and not use this for the purpose of calculation, for the purpose of answering your MCQs or simulation. I hope it is clear. Kindly write note again. So when the effective interest rate and the coupon rate both are given to you, right? Both are given to you in the question. In question, use the effective interest rate, not the coupon interest rate. And you have noted. Shall I go ahead? Okay. And now let's come to. Okay, Siddharth, shall I write it again? Just a moment. So I'm just writing it again because maybe it is not legible. In case you are given both interest rate, effective interest rate and the coupon interest rate, both given in question, use effective interest rate, not the coupon interest rate. This is the example of the effective interest rate. This is the effective interest rate calculation. I think you are asking about this, Siddharth. Okay, we'll start that. Let's start and go to the book and let's read from the book. Okay. Weighted cost of capital, we'll do it later. So let's come on this page, the weighted average cost of debt, 2.2, right? So let's read this. The relevant cost of the long-term debt is the after-tax cost of raising the long-term funds through borrowings. So the relevant cost is, in case of it, is the after-tax, right? Not the pre-tax. Relevant is this, not the pre-tax, right? The sources of long-term fund generally include long-term fund, right? Generally include bonds, long-term loans. These are generally what is generally included, right? The debt costs are generally stated as the interest rate of the various debt instrument, right? So for example, it is stated as a generally stated as interest rate in the terms of percentage it is given. In some cases, debt costs are stated according to the point basis about the US Treasury bond rates, right? In case some cases it is mentioned as a point basis also. Okay, what is the basis points, right? So every basis point is a percentage. For example, when I say 100 bips, right, 100 basis points, right, that means it is 1%, right? For example, the interest cost is, so it is, this is divided by 100 is the percentage, right? So for example, if I say it is 600 basis points, so it is basically nothing but 6%. right? Okay. Right. So debt costs are generally stated as the interest rate of the various debt instrument. In some cases, debt instrument are according to basis points above the US Treasury bond rates. So in the word, the safest instrument is the US Treasury bond. Nothing is safer than the US Treasury bonds, right? US Treasury instrument rather. If the entire world collapsed, I think the safest instrument is going to be US Treasury bonds. So in the terms, sometimes it is mentioned as a percentage. For example, say the coupon is a 10%, straight away it is given, or sometimes it could be given in the terms of US Fed rate plus 300 basis points, right? US tax rate is something which is keep on fluctuating and is mentioned on the website. You can go and check that. So for example, it is 1% is this, and then again the 300 basis point is going to be 3%. So the interest cost would be 4% for you. This is the similar thing you would have seen for the LIBOR, London Interbank borrowing offering rate, and then you have done the LIBOR, Euribor, MIBOR, the various methods for the same. Here it could be mentioned like this, or it could be mentioned like this. I hope it is clear. Okay. The weighted average interest rate is calculated. How would you calculate the weighted average interest rate? By dividing the company's total interest obligation on an annual basis by the debt outstanding. The same formula we have done, but this is pre-tax. This is what you're calculating. It is pre-tax. So I would say it is step 1. How will you do it? Which is effective annual interest rate. Annual is very important here. And then the debt outstanding. Debt outstanding, we have said, it is the net debt outstanding. So it is basically the net cash which you have received. Would we hear? So this is what you have got, the pre-tax. So pre-tax cost of debt represents the cost of debt before considering the tax shield, effects, right? So this is the pre-tax. What you have done? It is pre-tax. Once you consider the pre-tax effect, it is called the after-tax cost of debt, which is because interest on the tax is tax deductible. We have done that because it is something which is getting deducted over the PAT. The tax savings reduces. The tax saving is something which is reducing the actual cost of the debt, right? We have done that. So we have done tax savings. We have done it is reducing $30. We have done that, and actual cost is tax saving was $9 in our case, and actual cost was $30. So that is why we were taking the 29 in our case, 21 negative in our case, right? So that's the same formula. Nothing but whatever the interest rate is coming here, you use as the pre-tax 1 minus tax rate. Don't confuse with the formula. It is the same thing we have done. In case you want to skip that, feel free to skip that, because whatever the MCQs are based on, we have already captured that. So in case you find it irrelevant or something, you find it duplication, feel free to remove that also, right? So let's do one illustration without seeing the answer, obviously. So assume that the long-term debt component, right? Assume that the long-term debt component of a weighted average cost of capital of a firm includes the pre-tax cost of debt is 12.5%. So it is pre-tax, right? And the 30% tax percentage. So first of all, what we need to do? We need to calculate the post-tax. We need to calculate the after-tax. Simple. So we'll do pre-tax rate multiplied by after-tax rate. So we will reduce the tax shield. So which is this, which is the pre-tax rate. We'll use the pre-tax rate multiplied by the tax shield, which is 30%. We have done that. So which is going to be interest 1 minus tax, right? And this will work out to be 8.5%, 8.75%. Sorry. Although the pre-tax rate is 12.5%, the after-tax interest rate after considering the deductibility of the interest expense is 8.75%. Note that if the tax rate increased to 40%, right? Right now, what is the tax rate? Is 30%. So now it is increased to 40%. What do you think? Would be helpful for you or would not be helpful for you? Would be very helpful for you. Why? Because the way we done, interest is a tax expense, and the more marginal tax rate is increasing for you, it is advantageous for you, right? So in this example, if the cost of is increasing to from instead of 30, it is going to 40, what will happen? The cost of debt would decrease to 7.5%. From 8.75%, it will obviously reduce to 7.5%, right? Because now it will be, this is the tax sheet. So that's why whenever you're taking the debt, right, and the tax rate is going up, it is advantageous for you. I hope it is clear. It's a pass key. Which sheet are you talking about the example? Okay, you want to see the previous sheet, example 1. This is the example sheet. Yep. Okay, we can move ahead. See, debt carries the lowest capital. We have done that already. It carries the lowest cost of capital, and interest is tax deductible. Higher the tax rate, whatever the higher tax rate, more tax incentive you get in that case, right? This is the past summary of that, right? So we have done the debt. Now next in line comes the cost of preferred stock, right? So what is cost of preferred? What is the cost of preferred, right? So first is obviously the debt, then the preferred stock, and then the equity, right? Okay, so cost of preferred stock is the dividend paid to the preferred stockholders after tax consideration are irrelevant. So whatever the after tax consideration are here are irrelevant. Why? Because it is not deductible. It is not a deductible amount, right? It is not a tax deductible amount. That's why it's irrelevant here, right? What is the formula for that? So cost of the preferred is going to be preferred stock dividends divided by net proceeds. This is important. So it is going to be net of charges. Whatever the charges you are receiving, it is going to be net of charges. So it is going to be again the same. It is going to be net cash flow. Yeah. Okay. Preferred stock dividends. Preferred stock dividends can be stated as a dollar amount or the percentage. It could be given as a dollar amount or can be used as a percentage. For example, the 5% stock preferred stock pays an annual dividend of 5% of the par value. Stock dividends is always calculated on the par value if the dividends are declared by the corporation, right? It is always on the par value, right? Net proceed of the preferred stock. The net proceed from a preferred stock issuance can be calculated as the proceed net of the flotation cost. So you will reduce the net of flotation cost is there, then you reduce it. Guys, I'm not able to see all the questions, right? Because it is not coming on my window. I'll address all the queries after the session. I'll keep a 15 minutes every day, every session for the queries because I just cannot see query all the time, and I'll address all the queries in a structured manner. Don't worry about that, right? So let's see the cost of the preferred stock. Let's do an example. See, assume the preferred stock component of a weighted average cost of capital is 10%, right? And with a 10% par value that are issued at the par value with a flotation cost of $5. So the par value is 10 on which you will calculate the dividend, obviously. But when you calculate the denominator, you will reduce this amount, correct? Let's see this. So compute the cost of the preferred stock, right? So preferred stock dividend is going to be dividend percentage times the par value. It will not be on the net value. It will always be on the par value, right? It is not going to be on the $95, right? So $10, and then here it is going to be net. Here it is not going to be face value. So with this, and this is going to be 10.53. I think it's easy peasy. Okay. I'll just leave you here in case you want to write. Okay. The last in line is cost of retained earnings, or it is also called the cost of equity. There are many methods of calculating the cost of equity, right? But here we are only limiting only the three models, right? Which is CAPM, capital asset pricing model, discounted cash flow, DCF, and third is BYRP, which is bond yield plus the risk premium. Obviously, there are many methods for that. You would have done in your college and your CA, you would have done it much more method than this. But here we're limiting only to the three, right? So the cost of the equity capital obtained through the retained earnings is equal to the rate of return required by the firm's common stock. The rate cost of retained earnings is almost equal to the firm's common stockholders. A firm should earn at least as much of any earnings retained and invested in the business as the stockholders could have earned as an alternative investment of the equivalent risk, right? So in case the firm is retaining that money, the firm should at least give that much value that the investor would have, right, in case they are looking to invest in anything else, right? This is the more or less the ideology. In case you are following the Warren Buffett, he also applied that. He said, in case I'm holding that $1 with me and I'm not reaping that money to the investors, right, then the dollar should earn that much money in the business, then the investor would have got it. In case I think there is not much opportunity for me to invest, I probably give it as a dividend, right? So this is the same thing we are doing it here also. It should earn at least that much of an earning if you have earned on an alternative investment by the investor on the alternative investments, right? As mentioned above, the after-tax consideration are irrelevant. Again, it is after-tax consideration are irrelevant because it is below PAT. It is not a part of this, so it is below PAT. Because the dividends are not tax deductible, arriving at the components of the formula for the cost of retained earnings can be difficult and potentially subjective. There are three common methods. They are not the exhaustive method, or calculating the cost of retained earnings or cost of equity also you can say. This is going to be the highest, the cost of equity we have done, because they are taking the maximum risk, and that's why they are expecting the maximum return, and that's why the cost of equity is going to be the maximum, right? Now let's understand the capital asset pricing model, CPA model. I think you guys have done it earlier also. I'll just quickly help you out with that. Okay. What is capital asset pricing model, right? So we are calculating the cost of equity, or what I can say, it is the expected return for the investor, right? We have done that. So whatever is the cost for the company is the return for the investor. We are looking for that same. So for example, the investor is looking for that. Investor is saying, okay, I don't want to take any risk. I just want the safest instrument. What can I do to have that? So you can say, okay, you want the safest investment, go and invest in the Fed securities. That is the safest on the world, safest on the earth to have this investment. So you go and invest that. This is called the RFR. Various countries have their own bonds, they have their own FD interest and everything, which is considered as the risk-free, right? Obviously, the different risk-free across the country, it varies because different depends on the different sovereign guarantee of that country and different guarantee and the ratings of that country. For example, India rating is approximately BBB minus, US rating is AA plus. So it obviously depends on the sovereign rating of your country. But in case I limit it to only one country, whatever is related with the government's bonds is considered to be the risk-free return. So what do you say? In case I'm not taking any risk, so I'll go and invest in a government bonds, right? Or I can say the government bonds. That will be risk-free return. That is the return I'll get. Then you say, okay, I am ready to take certain risk, right? So what we have done, risk high, and then you expect the higher return, correct? So say, I'm taking more risk. I'm ready to take more risk. Instead of investing in the RFR, invest in the FD. What I want to do, I want to go and invest in say market, right? I want to go and say invest in Nifty, or in case you are looking for the US, it is going to be Nasdaq. Or Dow Jones Industrial Average. So I'm just talking about the index only. Oh. I don't know what. Just a moment. And then you say that I'm going to invest in Nifty, right? So this is something which RFR is something which is fetching your interest of 5%. And in case you see the Nifty return since its beginning, it's approximately 14 to 15%. So in case you invest in Nifty, you are expecting a return of 15% because you're taking a return of 50%, right? So you're expecting a more return because of that. So in case I compare with that, so what will happen? RFR is 5%. And because you are going from RFR, you're going to RMR, you're taking that risk. For that, you want some risk premium. So what is that risk premium? For example, you're investing in that RMR, which is the Nifty, where you give the return of 15%, and then you reduce that return with the RFR, right? You're getting the return 15. So this is your market premium. Or I can say market risk premium. So instead of investing in 5%, you're investing in the market, right? You're investing in the market. So you're expecting this much premium, right? So this plus this is what I need. Right? If I just end this equation here only, this RFR will get deducted with the RFR, and your return is going to be, your return or the cost is going to be RMR, correct? If you look in the formula, this will get cancelled, and your return is equals to RMR. Whatever the market is earning, you will get that earning. Or I can say it is the market risk premium you are doing. I hope it is clear to you here. This is what when you are actually looking. This is when you are looking to invest in RFR. This is when you are looking to invest in the market, but you are not looking to invest in the market. You are looking to invest in a particular company, right? So, for example, you look to invest in Tesla, right? And you say that I want to invest and see how the company is doing in that sense, right? When you compare, when you invest in a company or when you invest in a particular asset, right? You want to see how the company that particular asset is doing vis-a-vis the market. And when you do that, the measure you use for this is called the beta. Beta is that thing which helps you in comparing the market return versus the asset return or the investment return. So which helps you in ascertaining the level of the Tesla relationship with the market. Right? I'll just summarize everything. For example, first, in case you're looking for just the average return, you'll go for this. Then you look for, I want to take more. Then you'll go for market minus RFR, which is the market risk premium. But then you're saying I'm going to invest in a company. in a particular company I want to invest in, then that would be RFR plus the point, the relationship between the market and this. This would be the risk premium of that particular asset where you're actually investing, or particular stock if I talk about. This is the risk premium of that stock. This is the risk premium of the market, where because you are investing in the market. This is the risk premium. This shows the risk premium of that particular stock or the asset where you are actually investing. When you're calculating, because you're calculating the cost for the company, that is why you use this formula, and that is why the return for the investors, and this is the cost for the company. So this is the method that you apply for the for calculating the CPA method and for the cost of equity. Okay. What beta denotes? Let's understand what beta denotes. Beta basically denotes the relationship between how the market is responding and how your actual return is, your company is investing, where you're in it. For example, in our case, how the Tesla is responding vis-a-vis the market, right? Vis-a-vis the Dow Jones Industrial Average, how the Tesla is responding, right? So, for example, the beta is 1, right? What it means is the way that the market is moving, so for example, market is going up, the company's share will also move up. If it is going down, it is also going down. It is going equally, right? It is completely equal. So risk is equals to, here the risk is equals to the market risk, right? Because you're working in parity with the market, right? Okay, let's just do it in an example so that it will be much more easier for you to understand. Right? So cost of equity is equals to RFR plus beta RMR minus RFR. Let's assume RFR here is 5%, RMR is equals to 15%, and beta we keep on changing. So for example, we have assumed the beta is equals to this. So we are saying that it's an equal risk. So here it is going to be 5% plus beta is 1, 15% is the market return minus the 5%. So that means the risk is exactly equals and the return is going to be exactly equal to the market. So it is going to be 5% plus it is going to be 10%, it's going to be again 15%, which is exactly equal to the market return, right? Because the beta is 1, you're getting the same kind of return the market is getting, right? If it is falling, for example, the market is falling 15%, your stock will also fall 15%, right? Let's assume that beta is more than 1. Say for example, let's say the beta is 1.5, right? What would be the cost of equity in that case? 1, 5%. I'm using the same formula here, right? Plus beta is 1.5 and 15% minus 5%. So it is 5% plus again 10% is going to be 15%, 20%. So just because the beta is higher here, you're getting the higher return, right? Vis-a-vis this. So you're responding much wider than the market, right? So market is giving the return of 15%, but you will get the return of 20%. And it will go the other way around also. For example, the market falling 10%, you will fall much more than that. That's why when it is more than 1, if it is 1, it is as risky as market. If it is more than, it is riskier. It is something riskier than market. Let's say the third example, it is less than 1. Say for example, it is 0.8. Now let's put the same figures here. 5%, same formula which I am using, plus 0.8, 15% here, minus 5%, 5%, plus is going to be 10 and is going to be 8%, it's going to be 13. Here the market is growing 15%, but you're just growing 13%. You're not growing as the market is growing, right? So here the risk is much lesser. In case the market is falling, you are falling lesser, right? So here the is less risky. I hope it is clear. Just jot it down in case you want to make a note of it. Okay, I'll just explain more, and then I'll give you some enough time so that you can jot it down, right? Okay. Till now we have done beta is positive, right? We have done that. So when you say beta is positive, what does that mean? That means if I plot here return, and if I plot here say period, for example, the market is going up, right? Which I'm saying RMR, and then I'll say the stock is also increasing up. So this is the cost, this is the stock, I will say cost of equity with this. So it is equal, right? So here the beta is obviously 1, right? Because it is exactly going up. In case let's say if the market is falling, RMR, it is also falling. So here the beta is 1. It is exactly gaining and falling in the same ratio. Sorry, it's not RMR. It's cost of equity, right? It is just the same. Okay. In case the RMR is going there is RMR, but the stock is not. It is obviously increasing, but it is not increasing to that level, right? So that means the beta is positive, right? It is increasing the way the market is increasing, but the variability is lesser. So it is less than 1. Correct? In case it is moving more than that, right? Here your beta is more than 1. But in all the 3 scenarios, right, we have done the same in the equation. Now we have done the chart for the same. But in all the 3 scenarios, like when it is 1, it is less than 1, it is more than 1. In all the scenario, there is a positive relationship, right? There is a positive relationship. So it's a positive correlation, right? So if the market is going up, the stock is also going up. If market is falling, the stock is going up. Now the question comes in: can beta be negative? Can beta be negative, or can beta be 0? So that means, what does that mean if I talk about this? Negative meaning, if the market is going up, would there be chances that the stock is not going up? Instead, the stock is falling. The market is going up and the stock is falling, or any other commodity is falling. It happens. It generally happens in case of I would say it's generally happening in case of the market and the dollar relationship, right? So what does it mean is, generally what happens when the market, when I say market, I say Nifty is going up, what happens? A lot of FI's money comes into India, right? So because of that, lot of dollars are available in the market. Lot of dollars are supply of dollar is available because of that. Supply is there. And whenever the supply of any product is going up, we have done the supply curve. Whenever the supply of anything is going up, so demand will falls down, and the price of that particular dollar, falls because of that. So because of that, there is an inverse relationship between the dollar price and the market price. So as the market goes up, the dollar prices falls. It's a general thing, but this is something which is the case, and this is the reason for that, because a lot of investments are coming there. I hope it is clear. It is also the other way around also. For example, Nifty is falling, Nifty is getting sold. And why is it get sold? Because the money which FIs was investing, they are taking out all the money, and because of that, there would be a lesser supply of dollar, and there was scarcity of the dollar. Because of that, there would be scarcity of the dollar. This will push the prices of the dollar up, and there would again be the inverse relationship. So when you say inverse relationship, that means the beta is equals to going to be negative. Yeah. Okay. Another question comes in: can beta be 0? That can be that. I don't care where the market is going. Can there be a 0 beta? Yes, there are some scenarios where the beta could be negative. For example, in case you are investing in the RFR. So, for example, you have invested in the in the federal securities, right? Or in case you have invested in an FD, right? Say you have invested in FD. FD rates are terrible these days. But say, for example, 5.5% you're investing, FD rate is going on. So it doesn't matter whether the Nifty is going up or Nifty is going down, your FD rate will not change. It is fixed for that particular duration. In that case, it just completely has no impact because of that. So that means whether the market is going up, RMR, doesn't matter. Your RFR will remain the same. Okay, in the earlier I have not mentioned this. So RFI is going to be static. Let's just use that in the equation also. So for example, what we have done, cost of equity equals to RFR plus beta RMR minus RFR, right? So RFR was 5%, and let's just say 5% here only, just to avoid the confusion. Okay, 5% plus beta is 0, 15% minus 5%. Since everything is 0, so your return is also going to be 5% only, because it doesn't matter what is going in the market. So yes, your beta can be 0 also. In this example, how would you denote the relationship in a chart? For example, in case your market is going up, RMR is going up, your stock pricing is falling, right? Or say the dollar prices are falling. So this is the negative relationship or the inverse relationship. I hope it is clear. I'm just giving you time to jot it down. Starting with this. Just keep pinging once you're done, so that I keep moving the pages, so that you can jot it down completely. Just pinging me guys whenever you're done writing, so that I'll keep on moving. Just you carry on, just keep pinging me whenever you're done. I'll keep checking. I hope you're done. So I'm moving it to the next slide. Yes, this is the last slide. There's a previous to it. Done. And this is the last slide. Hope everyone has written. Can I switch off this? Is it done? Okay, we'll stop it here. We'll have a quick round of revision, and we'll start the tomorrow's class, tomorrow's session from here only. We'll discuss a brief background about the beta, and then we'll have a brief background about the beta, and then we'll take it from there. Q&A session, we'll finish it tomorrow. I suggest, don't send me the individual messages, put it on the group, and then I write the way the hashtag askAR, and then I can see that accordingly. And I'll keep on compiling the questions, then I can address it, because then it'll be much structured. If I keep on doing it one by one, it would be very difficult. So yes, we can do that. Let's have a quick revision, and then we can close the session. I suggest when I'm doing this revision, it's very helpful for you to do it along with me, because otherwise just no point, because it's very important for you to revise along with me. So would be very helpful if you could do it. Yeah. So the first, what we have done for the debt and equity, there are various instruments for the debt and equity. What we have done, first we have done the commercial papers. Commercial paper is basically for, generally it's for 30 days. It is a unsecured instrument. It is basically for funding the working capital. If it is more than 270 days, it requires the SEC registration. Generally the people follow the less than 270 days. It is generally to fund the working capital financing. Issued by the large corporations. General investors are basically the large corporations, HNIs, but now the retail investors are also coming into it. It is a money market operation. Money market, capital market is something we'll do it tomorrow. It is a money market, and yes, generally the duration is 30 days, right? So this one, what we have done into the commercial papers, right? Then you have the debt, debentures. What you have done, debenture is also unsecured, right? But you can still have a negative pledge. Negative pledge will be helpful for you to mitigate your risk. After that, we have done subordinated debt. Subordinated debt is a further down category than the debentures, and you will get the least amount of priority. Here it is also unsecured debt, right? After that, we have done income bonds. Income bonds is income and high yield bonds, where you issue it at the time of the reorganization, right? And you get the interest income only after you met the certain criteria of the income interest of the income level, right? For example, if you crosses the $50 million, only then you get that amount. Then we have the line is the junk bond. Junk bond is junk bond, high yield bond is a non-investment grade bonds. This is something which is issued by the company which is in a terrible shape, and generally they are issued in case of when you're looking to raise restructuring, or when you're looking to structure the LBO. This is when it is given. After that, we have done the mortgage bonds. Mortgage bonds, where the individuals take the loan under their residential and the commercial property, and the loans are pooled together, and then they are pooled together and sold as a corporate bonds. The advantage here is the investor does not have to go and forfeit the mortgage property. It is something which is done by the custodian itself. Financial lease, operating lease, we have done that from the lessee perspective. If it is something which is more than 12 months, if it is something which is less than 12 months, it is operating lease. If it is more than 12 months, you have to see 5 conditions, 1 by 5. If you satisfy any of the 5 conditions, which is owns, if you satisfy any of those conditions, it is going to be financial lease. Otherwise, it is going to be an operating. It is your wish. How do you want to show it? We have done that. After that, we have done the equity, preference dividend. We have done that. After that, finally, we have done the cost of debt. Cost of debt is going to be in case cost of debt. 3 notes we have done in cost of debt. In case if nothing is mentioned, whether it is a pre or post tax rate, and the tax rate is not given, assume it is always a post tax, right? And you will consider the tax shield in that. To assume pre-tax, you assume the tax shield, and then you arrive at the post-tax shield. In case the interest tax rate is given, use that. In case it is not given, calculate that. How would you calculate? Interest 1 minus tax divided by the net proceeds of it, right? And lastly, in the cost of debt, in case the effective tax rate is given and the cost of debt is also given, in that case, use the effective tax rate, right? After that, lastly, we are doing the cost of debt, cost of equity. And what is cost of equity? Cost of equity, we have touch base only the first model, which is the cap-and model. What is the formula? Which is the risk-free rate of return plus beta multiplied by market return, which is the RMR, minus the risk-free rate of return. Beta could be positive, beta could be negative, beta could be 0. Beta, if it is beta is equals to 1, it is as risky as the market return. If beta is more than 1, that means it is a riskier asset, or it is a riskier instrument. If beta is less than 1, this is a less risky proposition. We'll continue from here, and we'll quickly revise the beta part of it, and I think we pretty much finished the cost part, and then we'll move to the VAC. After that, we'll do a couple of questions of the MCQs to test that. Do not read anything further beyond that. I suggest whatever we have done, the short revision, whatever the notes you have noted, just go through that, so that it will be very helpful for you to test yourself in the MCQs round tomorrow, right? And once it is done, we'll keep this short query and session there also, so that we can address the queries you have there also. In case you have any suggestion, you can drop me a message. In case you have any query, I suggest you drop the message the way I suggested you, so that it becomes more effective for us to address that. Going forward, I think once the evaluation process and everything is going to be sorted out for you guys, the group we have, BEC group, is going to be more about the addressing the queries. So you can ask the queries by doing the ask AR, so that I can filter out those queries on the group itself and do it. Tomorrow we are going to address in much detail about the written communication part also, because this is something which is not the technical thing. I am helping out with the technical material, but written communication is not that much of practical, is not much of the practical writing. It is more about the practice and how to go about that. We'll discuss that approach for the next 5-10 minutes in the class tomorrow, and we'll go ahead with that approach. So revision is the key. I tell you again, just revise it today itself, whatever we have done thoroughly. In case you think the notes are useful, keep those notes, and whatever the material you find irrelevant in the book, just cut it out. Don't worry about that, and then use that. So let's end this session. Thank you so much for the patience, and thank you so much. Happy Teachers Day to you also. Thank you.